Maybe it's July 4th, 2026. I don't know. When Judy said he will back the back end of the bond market to gold, we've talked about this before. Maybe they do revalue it to a much, much higher level. You got guys like James Rickards saying, yeah, they're going to revalue it to 24,000. And he has a metric by which he does it. I think it's M2 divided into the gold or whatnot, which would give the Treasury general account 5 trillion plus free and clear by issuing new gold certificates. And by the way, those gold certificates, the gold does not belong to the Federal Reserve, who prints 5 trillion and gives it to the Treasury. They get the cash value of it. The gold belongs to the people. But by printing that money, every $4,000 increase in the price of gold would give the Treasury general account 1 trillion free and clear. By printing that, you devalue the dollar by 40-50%.
Gold's monetary role is returning to the forefront as policymakers, central banks, and global trading blocs reposition for a major structural reset. Rising talk of revaluations, accelerating accumulation, and coordinated shifts in settlement systems all point toward a world where gold once again anchors economic stability. The signals are now too large to ignore, especially as the dollar's purchasing power, reserve status, and global influence continue to erode under the weight of political and financial pressures. Andy Schectman, a longtime precious metals analyst and wealth management executive, outlines how these developments are converging into a coordinated shift toward higher gold valuations and a weakened U.S. dollar. He explains how proposals to back long-dated bonds with gold, combined with the mechanics of issuing new gold-linked certificates, could unlock trillions in Treasury liquidity while simultaneously devaluing the currency to reshore manufacturing. Schectman points to the emerging settlement architecture across the BRICS region, Hong Kong, Saudi Arabia, and Belt and Road vaults, as further evidence of gold's rising influence. Meanwhile, stablecoin infrastructure anchored to U.S. Treasuries is creating synthetic demand for both debt and bullion, with central banks quietly hoarding unreported gold and geopolitical blocs preparing alternative payment networks. The long-term path for gold appears dramatically higher and structurally unavoidable. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Central banks are no longer just buying gold, they're actively hoarding it. And it started then. And it's interesting, there's a fine line between conspiracy and reality. And I'll give you an example. But before I do, you got guys like James Rickards saying, yeah, they're going to revalue it to 24,000. And he has a metric by which he does it. I think it's M2 divided into the gold or whatnot, which would give the Treasury general account 5 trillion plus free and clear by issuing new gold certificates. And by the way, those gold certificates, the gold does not belong to the Federal Reserve, who prints 5 trillion and gives it to the Treasury. They get the cash value of it. The gold belongs to the people. But by printing that money, every $4,000 increase in the price of gold would give the Treasury general account 1 trillion free and clear. By printing that, you devalue the dollar by 40-50%. What did Trump talk about yesterday? We've done 18 trillion in manufacturing, brought it home to build manufacturing centers and this and that. What does he want to do? He wants to bring home manufacturing. Now, here's the fine line between conspiracy and reality right here. The raising of the gold price is actually devaluing of the dollar. That's what they want to do to sell manufacturing to the world. You'd have to relinquish the world reserve currency. What did knucklehead Jared Bernstein say? He is a moron. He was the chief economic advisor for Biden, but watch him try to explain Treasury creation. It's the most humiliating thing you've ever seen someone do. I know you remember that. His report, Dethrone King Dollar, speaks of losing the reserve status. Triffin's dilemma, no longer good for the U.S. We can't ever not have a trade imbalance being the world reserve. Vice President Vance said the same thing on White House letterhead, right? They don't want it. They want a devalued dollar to bring back manufacturing because we don't make anything anymore. 60% of this country has a literacy rate below that of the 6th grade. For God's sakes, we're broke, we're stupid, we're insolvent, and AI is going to kneecap how many jobs? At least the majority of entry-level jobs. And so when you talk about the need to bring back manufacturing, and by the way, that doesn't take out of the equation that manufacturing having robotics and AI in it. Regardless, we need it. right? We need it because people are going to be in big trouble in this country, period, in terms of employment and in terms of the country being at a compromised position, a very risky one, to be reliant on the world for all of the things we need, from pharmaceuticals to airline components to military. We need to manufacture stuff, period, right? We have to. So that would require a few things. One, reshoring gold, and they called it tariffs. I said, bullshit, it's tariffs. It is not tariffs. They're reshoring. Wake up. It's a ruse. Number two, they would need to shed the reserve status. Well, Bernstein said so. Vance said so. You can see that it's no longer in their best interest. And what are all the countries of the BRICS trading? Local currencies over a bridge network, or the SIP system, cross interbank payment system, something like that, that's not controlled or compatible with SWIFT, right? Settling imbalances in what? Oh yeah, gold. We'll settle imbalances in gold. And that's the Shanghai Metals Exchange building all these multi-jurisdictional vaults. First one in Hong Kong, metal that leaves China has to go through Hong Kong. Oh yeah, so Saudi Arabia can sell their oil to China for digital yuan, which is now immediately convertible into gold without going back into dollars. Do it through the Shanghai vault. You got the gold. Where's the second vault being built? Oh, that's right, Saudi Arabia, right now. And then throughout the whole Belt Road, gold is going to be the settlement system for that side. Let's go back over here. All right, so you want to bring back manufacturing. So you get rid of the world reserve status by, in essence, devaluing the dollar. And more or less telling the world through our fiscal irresponsibility, you're an idiot to hold our dollars. But that's really what we don't want. We don't want to be the reserve currency because we want to bring back manufacturing. Trump talked about it all day yesterday in his speech. And so you do that, you reshore the gold, which Judy says you peg to the back end of the bond market, which we've talked about. But that line between conspiracy and reality in terms of where does gold go? Here's one place. You talk about the Genius Act, right? And the Genius Act is diabolically genius in the respect that anytime money moves, once this is fully implemented, it has to be done so by stablecoin. The stablecoin is then backed by U.S. Treasuries, according to the legislation, right? So look at USA Tether, who will probably be the primary benefactor of all of this. USA Tether, their new CEO is none other than Bo Hines. Bo Hines was Trump's crypto czar through August. Wink, wink, nod, nod. Here's what you're going to do, Bo. When you take and move, anytime money moves from a pack of chewing gum, a pack of cigarettes, a new car, or a new house, it doesn't matter. It's moving a la stablecoin. Bang, settle just like that. No more checks, no more wires. Boom, settle. All right, it's backed by stablecoins. Those stablecoins are backed by treasuries. The interest on those treasuries is not transferable. So Tether keeps the money, the interest. What are they buying? 12 or 13 billion in gold already? And Bitcoin. I think they want to let Bitcoin go higher and continue to rug pull it to pay down the debt. I think they want, and devalue the dollar, by the way, but I think they're continuing to buy gold. And as much as they're going to be buying not only as many treasuries and as much gold as countries do. And all of that gold accumulation devalues the dollar. Now, did they work out a deal to sell it to the Treasury? Maybe. He was his crypto czar. He was his advisor. Now he's a CEO. He made the rules that he's now benefiting from. Okay, fine. You're going to make lots of money, Bo, but here's what's going to happen. You're going to sell that gold to the U.S. government when we come calling. Until then, you take the interest that is not transferable to the holder of the stablecoin. All of that money, you keep buying gold. Where were they just a few months ago, Tether? At the Beaver Creek Mining Summit, talking to the actual miners. They're buying miners and they're buying a shitload of gold. And they will continue to do so anytime money moves. Not only will it be synthetic demand for the Treasury, keeping rates low, it'll be synthetic demand for the gold market, letting the price rise. And then at some magic moment, maybe it's July 4th, 2026, I don't know, when Judy said he will back the back end of the bond market to gold. We've talked about this before. Maybe they do revalue it to a much, much higher level. They let it rise organically, a la synthetically of the stablecoin moving until you get to that point. But what I'm getting at is that all of this would, and if she's right, and they do peg it to the back end of the bond market, you can bring back manufacturing at zero upfront borrowing costs. Build the new high-tech manufacturing centers, at zero upfront borrowing costs and redeemable in gold. So at some point, and her book said 5, 10, 20, 30, not just 50 year, the redeemability is in gold. There is no interest. And the more stupid we are with fiscal and monetary policy, the higher the price of the gold goes. But you bring back manufacturing and no upfront borrowing costs, and you have a massively devalued dollar to sell your product to the world at. Could it happen? Yeah, I think it could. And when you see Bo Hines as the CEO of USA Tether, it really makes it seem like, could it just be a coincidence? Like everything else that we see all the time? No, it's not. I think it's part of the plan. And when he keeps harping on manufacturing, and your own vice president writes about it on White House letterhead, that Triffin's dilemma is such that we cannot be the reserve currency anymore. And the last knucklehead, Bernstein, said the same thing years ago. We're getting to the point where the realization is countries will trade their own currencies and find a way to settle imbalances in something universal like gold. That, I believe, is a very long-winded answer to your question. But yes, ultimately, I think gold will go higher than anybody thinks possible. And I'll leave you with one last thought about this. The people who are bringing this gold back in the billions and billions that we know of, because we just heard that only 1 out of 3 transactions is being reported. Most of the gold that central banks are buying isn't being reported. It's bought through a proxy bank, or it's not 995 fine, or it's just brought in some other way because it's voluntary. It's not mandatory that they report it. Yeah, these people don't do things just for shits and giggles. They do it because they understand the monetary system is evolving and gold is being put back into it. It's going to back the Treasury here, and it's going to be a settlement system over there, if I had to guess.
Silver continues to show signs of structural tightening as global policy decisions, supply restrictions, and elevated borrowing costs converge into a rare and powerful setup. Multiple governments have now classified silver as a critical mineral, while China's supervised commodity designation restricts outbound flows and reduces global supply. Sustained backwardation across the futures curve, combined with repeated failures to restore normal contango, signals genuine physical scarcity rather than temporary imbalance. Spot buyers are paying above futures prices, inventories remain pressured, and delivery requests into year-end continue rising. At the same time, countries such as India, Saudi Arabia, and Russia are expanding strategic stockpiles, while import prices, lease rates, indicate tightening conditions across wholesale channels. Institutional models are also shifting, with major firms recommending increased precious metal weighting as stress builds across global exchanges. Let's get back to the interview.
The U.S., of course, making silver a critical mineral. The Chinese government made silver a supervised commodity. What that means is every ounce that leaves China has to get permitted through Beijing. And look, the European Union made silver a critical mineral 2 years ago. The world has growing concerns, if you will. Governments around the world have growing concerns about the availability of silver. And I think, honestly, that these countries, these nations will make efforts to not only reduce exports, which feed the market, such as London and the COMEX, and by contrast or by extension, rather, the ETFs. I think that when you talk about could this happen, could we see that moment? Yeah, why not? I don't think it's imminent, but I think that there is a possibility. You look at India, their silver imports are up 500% year over year. One of the things that's most interesting is the sustained backwardation in silver. And I think that gets to what these people are talking about, because since early October, the silver futures curve has flipped into sustained backwardation. And it's not normal. It's unusual to see that in silver, period. And it's one of the clearest signs of I guess you could say, physical scarcity, along with multiple attempts to restore contango, where the futures price is higher than the spot price. But, I guess we could just simply say, look, spot silver demand now exceeds futures supply. The metal is genuinely scarce. That's not just theory. And there's no question that paper selling has and can and always has suppressed price, but it can't suppress the structure of the market. And I think that's where things get interesting. To me, the most condemning thing for the silver market, at least, and supporting what they're saying, is that we've got about 7 or 8 days until the December gold and silver contracts go into delivery. And you can argue this is where paper meets physical, or the rubber meets the road. When you see silver 25 cents in backwardation, meaning the price is 25 cents, at least it was yesterday, higher than the futures price. And as the futures price, as you know, and the spot prices get closer to that expiration, they meet, right? What it's saying is, and it's unusual to see in backwardation 7 days before these contracts come off the board or post, someone wants physical now, not later. And with inventories tight, immediate demand is outpacing expected supply. This doesn't happen right before the expiration, unless arguably there's a big move in store for us. I would think with people really trying, pushing hard to get silver in their hand before this happens. So yeah, I mean, I don't know that there's a imminent collapse January 1, but you can see that there are things that are unusual and could certainly continue to put stress. And then you add the countries like China who are going to stop the ready flow, at least it looks that way, of silver exports, and in the U.S. making it a critical mineral. The one thing that I saw about the India thing, unless I read it wrong, it's only up to 500 grams or 10 kilos, 500 grams in coins, 10 kilos, period. So I don't know how substantial that is. If a kilo is 32.15 ounces, so you're talking $15,000 or so in collateral. Okay, that's cool. It's a start in the right direction. I don't know what it truly signals. And you're right, the central banks are buying. I wish Saudi Arabia would have bought it in a different form. Of course, buying it in SLV allows them to take possession at that level, which is interesting too. SLV has been the center of a lot of talk lately, with their borrowing rates being as high as 20% over the last couple of weeks, and not many shares to borrow. Interesting in that they had quite a few non-deliveries, although it's not a default. It's just the custodians who they weren't able to get shares or get silver timely enough, so it's kind of like a strike against them. But these conditions only appear when metal is getting hard to source. All of the things we've talked about, not to mention over 50 million ounces have already been drained from the CME warehouses this year. And when you look in your backyard in London, the OTC market, it's so tight that forward rates have flipped negative and lease rates have exploded. Lease rates a couple of weeks ago were what? They went up 200%. Again, these signals only flash when the market is stressed. I would argue, look, all of the things you said are true. Technically, silver is very strong because it's refusing to break its structure. Higher lows, solid support, not many sellers. So yeah, you could argue this time it is kind of different now that the central banks are buying aggressively, not just Saudi Arabia, India, Russia, adding it to their strategic stockpile. We've talked lots about China flying around Central and South America, buying doré and concentrate from Peru, from Mexico. You have the industrial demand surging, batteries and solar and EVs and nuclear and military. And the delivery requests keep rising. And spreads and borrowing costs are flashing stress. Yeah, everyone can see it now. And I would say that the most powerful players in the world are and have already been making their move. And to your point early on, about the retail, yeah, the retail is always the last one to figure it out. Because once the mainstream does figure it out, I think it's too late in the standpoint supply disappears. There's not a lot of supply. And you can see that really in the U.S. Mint production or the U.S. Mint premium numbers. A little bit of demand pushes the price up. Where's that demand coming from? I think it's very interesting in a world where Wall Street's never acquiesced to anything that you and I talk about, until all of a sudden the chief investment officer of Morgan Stanley says, that 60-40 platform we've used, 60 stock, 40 bond, it's now 60-20-20. Sell half your bonds, put 20% in gold. Or Michael Hartnett, the chief head analyst for Bank of America, says, no, make it 25% in gold. Or Jeffrey Gundlach, the bond king, says, oh, that 25% is not overweight. You can see that things are happening beneath the surface at the highest level. And if just a little bit of these people. They're talking to the institutional level. I have a very good friend who runs $3 billion for Morgan Stanley. He wouldn't know a gold coin if it fell on his foot. He's in the top 100 money managers in the United States for Morgan Stanley. He doesn't know gold, yet their chief their chief investment officer says, put 20% of your assets in gold. They're speaking to the institutional traders. And if just a few percent of those traders start to dabble in the retail market, it's going to have profound effects on premium and on availability. It's happening at the highest level in the exchanges, not only in COMEX and the LBMA, but in Shanghai now too, where they're getting close to shutting off the spigot because their stockpiles are so low. All of this comes to the same point, and that is that what starts out as a trot or a crawl, and then to a walk and a trot into the accumulating of physical assets by the big money, it hasn't turned into a sprint yet, but you can sense that it's accelerating globally. And now the countries are becoming open about it, classifying these things critical, seeing the imports into the countries, seeing the takeoff from the exchanges, seeing the commercial banks and their analysts and investment advisors at the highest level acquiesce to, yeah, maybe you should have 20 or 25% of your money in metal. These things are all, this time is different. So nothing surprises me at this stage of the game, including the statements that you talked about earlier about January 1, something happening. Maybe, maybe not. Who knows? But I think this is all the reason why you don't look at gold and silver as an investment. You look at it as shelter from what's coming, because the big money has already realized that and has already made a move and is in the process of continuing to make moves. That's not supposition, that's reality.
Growing instability across the global metals supply chain is reinforcing the shift toward hard assets as structural pressures build beneath the surface. Silver's classification as a critical mineral across major economies, combined with mounting export controls and declining inventories, underscores a tightening environment where immediate physical demand increasingly outweighs future availability. Rising lease rates and shrinking warehouse stocks reveal a market under strain as major buyers secure supply well before traditional participants react. These conditions align with a broader rotation toward tangible stores of value as financial markets confront rising volatility, higher funding stress, and waning confidence in paper claims. Institutional allocations are beginning to adjust as well, with prominent investment desks acknowledging the need for larger precious metal exposure amid tightening liquidity and accelerating shortages. With global exchanges flashing stress signals simultaneously, the case for physical ownership continues to strengthen as the cycle advances. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.